There exists a grand deception at the heart of modern ambition, a cognitive trap so pervasive and so deeply ingrained into the mindset of high achievers that it functions as an invisible ceiling on their potential for wealth creation. This deception is the belief that financial markets are a cerebral arena, a grand chessboard where victory is awarded to the player with the highest intellect, the fastest access to information, or the most sophisticated predictive model. The aspiring elite, driven by a relentless desire for an edge, pour their resources into this intellectual arms race. They subscribe to data services that promise to shave milliseconds off trade executions. They build complex algorithms designed to forecast the subtle tremors of market sentiment. They consume terabytes of research, listen to every word uttered by economists and strategists, and operate under the fundamental assumption that if they can just think harder, know more, or act faster than the competition, they will win. This is the foundational error. It is the reason why legions of intelligent, hardworking, and ambitious individuals spend their entire careers running on a hamster wheel of frantic activity, only to achieve returns that are at best mediocre and at worst catastrophic. They are playing the wrong game. Warren Buffett, a man who has compounded wealth on a scale that defies comprehension, did not build his $900 billion empire by playing this game. His colossal success is not a testament to a superior IQ, a faster computer, or a secret predictive formula. It is the result of a profound and radical reframing of the entire endeavor. Buffett understood a truth that escapes 99% of market participants. The stock market is not a game of intellect. It is a game of temperament. It is not about outsmarting the collective, but about outbehaving the collective. His primary weapon is not a financial model, but a psychological one. A mental framework so simple in its telling, yet so profound in its application, that it has allowed him to systematically transmute the most destructive human emotions, fear and greed, into the raw materials of his fortune. He achieved this by creating an allegorical partner, a fictional character who personifies the market's inherent irrationality. This character allows Buffett to disassociate from the madness of the crowd, to view the manic swings of market prices not as a threat or a signal to be deciphered, but as a series of often ludicrous business propositions from a deeply unstable associate. This mental model is the master key to his cognitive operating system. It is the engine of his contrarian strategy. It is the psychological shield that protects him from the twin sirens of euphoria and panic. We are not here to discuss investment tips. We are here to perform a deep, surgical deconstruction of this mental model. We are going to expose the cognitive architecture behind what Benjamin Graham, Buffett's mentor, first christened Mr. Market. We will reveal how this simple allegory functions as a powerful psychological tool to manage emotion, identify opportunity, and enforce discipline. You will learn how to stop seeing the market as an all-knowing god to be appeased and start seeing it for what it is, an often irrational, manic-depressive business partner whose emotional instability is your single greatest strategic advantage. This is the blueprint for emotional arbitrage. This is the secret to how Buffett weaponizes the market's inherent flaws to build an unassailable fortress of wealth. To understand this is to understand the very foundation of the Buffett mindset. Forget everything you think you know about beating the market. Today we learn how to partner with its madness. The genesis of this revolutionary mental model comes from Chapter 8 of Benjamin Graham's seminal 1949 text, The Intelligent Investor, a chapter that Warren Buffett has called, by far, the most important book on investing ever written. Graham, witnessing the psychological carnage of the Great Depression and the speculative manias that preceded it, sought to create a conceptual tool that would insulate the rational investor from the emotional vortex of the market. He knew that raw data and financial analysis were insufficient. An investor needed a behavioral framework, a story to tell themselves that would provide a bulwark against the primal instincts of fear and greed. And so he created the allegory of Mr. Market. Imagine, Graham wrote, that you own a small share in a private business. One of your partners in this business is a man named Mr. Market. He is a very obliging partner. Every single day, without fail, he comes to you and tells you what he thinks your shares are worth. And, on the basis of his valuation, he offers to either buy your shares from you or sell you his shares. This is the setup, and on the surface, it seems simple enough. But here is the critical detail, the feature that transforms this from a simple story into a profound psychological tool. Mr. Market has incurable emotional problems. He is a manic depressive. Some days, he shows up in a state of wild euphoria. He sees only a rosy future for the business. Every piece of news is the best news he has ever heard. On these days, he quotes a ridiculously high price for your shares. He is desperate to buy your stake, and is willing to sell you more of his at this inflated valuation. He cannot imagine the business ever faltering. The next day, or perhaps the next week, he might arrive in a state of utter despair. He is consumed by pessimism. He can only see challenges and obstacles on the horizon. The very same business that he was euphoric about is now, in his mind, on the brink of collapse. On these days, he quotes a ridiculously low price. He is terrified, and he is begging you to buy his shares from him at this bargain basement price, just to put him out of his misery. Graham concludes this allegory with the central, immutable rule for dealing with such a partner. The choice is always yours. You are free to completely ignore him. You are under no obligation to transact with him at all. His daily quotes are not a command, nor are they a definitive statement of the business's true value. They are simply offers made by a lunatic that you can either accept or discard. You should not be influenced by his mood swings. You should only engage with him on your own terms. You should happily sell to him when he quotes a ridiculously high price, and you should happily buy from him when he quotes a ridiculously low price. For the rest of the time, you are best served to ignore him completely, focusing instead on the actual performance and fundamentals of the business you co-own. This, right here, is the master key. This simple story contains within it a complete operating system for navigating the psychological minefield of the market. Let's deconstruct the core components of this mental model to understand why it is so devastatingly effective. First, and most importantly, is the act of personification. By giving the market a name and a personality, Mr. Market, the manic depressive Graham and Buffett achieve a critical cognitive disassociation. The market is no longer an amorphous, all-powerful, and omniscient entity called the market. It is not a deity whose judgment must be respected. It is just a guy. A deeply flawed, emotionally unstable, and often irrational guy. This act of personification is a psychological masterstroke. It demystifies and defangs the market. A price ticker flashing red is an abstract, fear-inducing signal that triggers primal survival instincts. But an offer from your crazy partner Mr. Market, who is in one of his depressive funks again, is an entirely different proposition. It frames the event not as a reflection of objective reality, but as a reflection of his temporary emotional state. This allows the intelligent investor to step back and analyze the situation with cool detachment, rather than being swept up in the emotional current. You are no longer reacting to the market crashing. You are simply observing Mr. Market having a panic attack. This reframing changes everything. It shifts the locus of control from the external market to the internal mind of the investor. The second powerful element is the establishment of agency. The allegory explicitly states that you are free to ignore Mr. Market. This is a radical concept for most market participants, who feel a compulsive need to react to every price movement, every news headline, every analyst upgrade or downgrade. They believe that action is synonymous with progress. The Mr. Market framework teaches the opposite. It establishes that your greatest power is the power of inaction. You are not forced to play his game. You are the one who decides when and if a transaction occurs. This directly connects to another core Buffett principle, the circle of competence. You only act when an opportunity presents itself that is so obvious, so compelling, and so deeply within your area of understanding that it would be foolish to pass up. The rest of the time, you do nothing. You let Mr. Market scream, you let him cry, you let him dance with joy, and you simply observe, waiting patiently for his emotional state to create a clear and undeniable opportunity. This transforms patience from a passive state of waiting into an active, predatory discipline. You are not idle. You are conserving capital and cognitive energy for the precise moment when Mr. Market's irrationality reaches its zenith. The third component is the separation of price from value. This is the intellectual bedrock of value investing, and the Mr. Market allegory is its behavioral manifestation. Mr. Market's daily quote is the price. The underlying long-term earning power of the business is the value. The amateur investor conflates these two things. They believe that if the price of a stock goes down, the value of the business has diminished. If the price goes up, the business has become better. The intelligent investor, armed with the Mr. Market mental model, knows this is nonsense. The value of a business is determined by its competitive advantages, its management, its cash flows, and its long-term prospects. The price is determined by the momentary emotional state of millions of people, personified by Mr. Market. Sometimes, these two things align. Most of the time, they do not. The entire game for Buffett is to wait for the moments when the gap between Mr. Market's quoted price and the business's intrinsic value becomes a chasm. When Mr. Market, in a fit of despair, offers to sell you $1 of business value for 50 cents, you act decisively. When, in a fit of euphoria, he offers to buy that same dollar of value for $2, you happily oblige. The rest of the time you let the noise fade into the background. This framework forces you to do your homework. You cannot exploit the gap between price and value if you have not first done the work to calculate, with a reasonable degree of certainty, what the value actually is. This is why Buffett spends his days reading annual reports, not watching financial news channels. He is focused on understanding the business, on calculating its intrinsic value, so that when Mr. Market shows up with a crazy offer, he can recognize it for what it is. The news channels are just a broadcast of Mr. Market's mood. Buffett is interested in reality. The Mr. Market mental model is, therefore, not just a defensive tool, it is an offensive one. It provides a two-stroke engine for wealth creation, perfectly calibrated to exploit the dual manias of the human psyche. Let's call it the engine of emotional arbitrage. The first stroke of this engine is activated during times of widespread fear. This is the condition Buffett famously described as, quote, being greedy when others are fearful. When Mr. Market is in the depths of despair, when he is consumed by panic and is offering to sell high-quality assets at absurdly low prices, the engine fires. To understand how this works, we must first deconstruct the psychology of a market panic. A crash is not a rational, orderly repricing of assets based on new information. It is a cascading psychological contagion. It begins with a negative catalyst, a financial crisis, a pandemic, a geopolitical shock. This initial event triggers a wave of selling. As prices fall, a powerful cognitive bias known as loss aversion kicks in. Psychologically, the pain of losing $1 is twice as powerful as the pleasure of gaining $1. As investors see the value of their portfolios decline, the emotional pain becomes intense, prompting them to sell simply to stop the bleeding, regardless of the underlying value of the assets they hold. This initial selling pressure is then amplified by herd instinct. Humans are social creatures, hardwired for survival to follow the actions of the group. When we see others panicking and selling, our brains interpret this as a signal of a genuine threat. The fear of being left behind, of being the greater fool holding on while everyone else gets out, becomes overwhelming. Social proof takes over. The fact that everyone is selling becomes its own justification for selling, creating a self-reinforcing feedback loop. This is then layered with recency bias, the tendency to overweight recent events and project them indefinitely into the future. As the market falls for days or weeks, investors begin to believe that it will fall forever. They lose all perspective of long-term business fundamentals and become fixated on the short-term price action. Their time horizon collapses from years to minutes. Catastrophizing sets in. The mind extrapolates the worst-case scenario from the current situation and treats it as an inevitability. Every news headline is interpreted through a lens of doom. Pundits and experts, themselves susceptible to the same biases, fill the airwaves with dire predictions, further fueling the panic. This confluence of cognitive biases, loss aversion, herd instinct, recency bias, and catastrophizing creates a vortex of irrationality. Mr. Market is having a full-blown psychotic break. He is no longer capable of rational thought. He is a creature of pure, unadulterated fear, and he is willing to sell you the crown jewels of the global economy for pennies on the dollar. This is the moment the intelligent investor has been waiting for. This is where the preparation meets the opportunity. While the rest of the world is reacting to the price, Buffett is focused on the value. He has done the work. He has his shopping list of wonderful businesses that he has been studying for years, waiting for them to go on sale. He has calculated their intrinsic value. His mind is anchored to this reality, not to the ephemeral madness of the market. The falling stock prices are not a signal of danger to him, they are a signal of opportunity. Mr. Market is screaming "Fire!" in a crowded theater, and Buffett is calmly walking towards the entrance, ready to buy the entire theater at a discount. A classic, textbook example of this principle in action was Buffett's investment in American Express during the salad oil scandal of 1963. American Express was, at the time, a blue-chip company, primarily known for its travelers' checks and credit card businesses. However, it had a smaller and largely unknown division involved in warehousing. This division had issued receipts for massive quantities of salad oil held in its tanks by a company called Allied Crude Vegetable Oil. The problem was, the salad oil didn't exist. The owner of Allied Crude had filled the tanks mostly with water, with a thin layer of oil on top to fool inspectors. It was a massive fraud. When the fraud was discovered, Allied Crude went bankrupt, leaving the holders of the warehouse receipts, mostly banks, with worthless paper. The banks then turned to American Express, claiming that as the issuer of the receipts, Amex was liable for the losses, which were estimated to be as high as $175 million. For perspective, American Express's entire net worth at the time was only $125 million. If they were found liable for the full amount, the company would be insolvent. Wall Street panicked. Mr. Market had a complete and total meltdown. The stock, which had been trading at over $60 a share, collapsed to $35. The consensus view was that American Express was finished. The narrative was one of doom. The fear was palpable. Every expert, every analyst was screaming, "Sell!" This was a perfect storm of fear, uncertainty, and a complex legal situation that most investors were unwilling or unable to analyze. But Warren Buffett, operating with the Mr. Market mental model, saw not a crisis but a proposition from his irrational partner. He refused to be swayed by the panic. Instead, he engaged in a simple, rational, and independent investigation. He did not focus on the stock price. He focused on the underlying value of the businesses. He went to restaurants and stores, talking to merchants and customers. He observed whether people were still using American Express credit cards and traveler's checks. He went to banks and asked them if they were still selling the traveler's checks. What he discovered was that the core businesses, the engines of American Express's value, were completely unaffected by the scandal in the warehousing division. Customers still trusted the brand. Merchants still accepted the cards. The competitive advantage, the economic moat around the payment and traveler's check businesses was intact. He concluded that the market, in its panic, was making a classic error. It was taking a problem in one small part of the business and extrapolating it to mean the entire enterprise was worthless. Mr. Market was catastrophizing. Buffett then did the math. He determined that even in a worst-case scenario, where Amex had to pay out a significant amount, the long-term earning power of its core franchises was so immense that the company was worth far more than the $35 a share Mr. Market was quoting in his panic. So while others were fearful, Buffett became greedy. He invested 40% of his partnership's capital, a massive bet, into American Express stock. Over the next few years, The legal situation was resolved for a fraction of the feared amount, the market came to its senses, and the stock price soared. Buffett had used Mr. Market's panic to buy a wonderful business at a ludicrously cheap price. This is the first stroke of the engine, weaponizing fear. It is the art of recognizing that a market panic is a temporary suspension of collective sanity, and that this insanity creates once-in-a-generation opportunities for those who remain anchored to the reality of business value. The second stroke of the engine is the inverse, and for many, the more difficult of the two. It is the discipline of being fearful when others are greedy. This is the part of the cycle where Mr. Market is in a state of wild, unbridled euphoria. He sees no risk, only reward. Prices are detached from underlying value and are being driven purely by speculation and a belief in a new paradigm. This is the psychology of a bubble. During a bubble, the cognitive biases are flipped. FOMO, the fear of missing out, replaces loss aversion as the dominant emotional driver. Watching your neighbors, your friends, and your colleagues get rich from stocks you don't own creates an intense psychological pain. The pressure to join the party becomes immense. Overconfidence bias takes hold. Investors who have made money in the rising market begin to attribute their success to their own skill, rather than to the bull market itself. They believe they have cracked the code and that traditional rules of valuation no longer apply. This is reinforced by social proof. Everyone is buying. The media is filled with stories of overnight millionaires. Experts are justifying the high valuations with new, creative metrics. The rising prices themselves become the justification for buying, a classic feature of speculative manias. This is all wrapped in the narrative fallacy. A compelling story emerges to explain why this time is different. In the late 1990s, the story was the internet and the dawn of a new economy. In other bubbles, it has been housing prices that can only go up, or a new technology that will change the world. This narrative provides the intellectual cover for the emotional speculation. During these times, Mr. Market is your dangerously euphoric partner. He is offering to buy your shares at prices that bear no resemblance to the underlying value of the business. He is also trying to sell you his shares at these same inflated prices, promising you that they will be even higher tomorrow. This is the moment where the intelligent investor, armed with the Mr. Market mental model, must exercise extreme discipline. It is the moment to be fearful. While the world is caught up in the greedy frenzy, the rational investor is quietly selling their holdings to Mr. Market at his absurd prices, or, more likely, simply refusing to participate in the mania. They are sitting on cash, patiently waiting for the inevitable return of sanity and the subsequent panic that will follow. This is arguably the hardest thing to do in investing. It requires an almost superhuman level of emotional fortitude. It means standing aside while everyone around you is celebrating. It means looking like a fool in the short term. It means accepting that you will miss out on some of the final, parabolic gains of the bubble. Buffett's conduct during the dot-com bubble of the late 1990s is the ultimate case study in this discipline. As the Nasdaq soared, doubling and then tripling in value, driven by internet stocks with no earnings and often no revenue, Buffett and Berkshire Hathaway famously stood on the sidelines. He was openly mocked and ridiculed. Barron's ran a cover story in 1999 titled, "What's Wrong, Warren?" Pundits declared that his value-based approach was a relic of an old economy and that he, quote, just didn't get it. The pressure on him to abandon his principles and join the tech party was colossal. His own shareholders were questioning him. But Buffett's thinking was anchored by the Mr. Market allegory. He saw a partner in a state of complete mania. The prices Mr. Market was quoting for these technology companies were, in his view, nonsensical. They were not based on any rational calculation of future cash flows or sustainable earning power. They were based on hope, on narrative, and on the greater fool theory, the belief that you could buy an overvalued asset because there would always be someone else, a greater fool, willing to pay an even higher price. Buffett's response was simple and unwavering. He said he did not understand these businesses. He could not, with any degree of certainty, project their earnings a decade into the future. They were outside his circle of competence. therefore he would not play. He was not making a prediction that the bubble would burst on a specific date. He was simply stating that the prices being offered by Mr. Market were too high for the value being offered, and the risk of permanent capital loss was too great. He was being fearful, while others were consumed by greed. He chose to do nothing, to sit on a growing pile of cash. This decision made him look like a dinosaur for several years. But when the bubble inevitably burst in 2000, and the Nasdaq lost nearly 80% of its value, wiping out trillions of dollars of speculative wealth, Buffett's discipline was vindicated. His refusal to dance at Mr. Market's euphoric party had preserved his capital. And that pile of cash he had patiently accumulated was now an immense war chest, ready to be deployed when Mr. Market inevitably swung from euphoria to despair in the years that followed. This is the second and equally crucial stroke of the engine, weaponizing greed. It is the discipline to resist the siren song of speculative manias, to accept looking foolish in the short term, and to preserve capital so that you are ready to act when fear returns to the market. So how do we translate this powerful allegory into a practical, cognitive operating system? How can the aspiring elite build their own Mr. Market filter to insulate themselves from emotional contagion and exploit the market's psychological flaws? There are 4 essential steps to engineering this mental framework. The first step is to internalize the practice of personification and disassociation. You must make a conscious, deliberate effort to stop thinking of the market and start thinking of Mr. Market. When you look at a stock ticker, do not see an objective measure of a company's worth, see an offer from your emotional business partner. When the news reports that the market is in turmoil, translate this in your mind to, Mr. Market is having a bad day. This simple linguistic trick is a powerful cognitive tool. It creates a mental buffer between the external stimulus, the price change, and your emotional response. It allows you to shift from a reactive mindset to an analytical one. Instead of asking, "What does this price change mean?" you start asking, "Why is Mr. Market so happy/sad today? And is his mood creating an opportunity for me?" Practice this daily. Narrate market movements to yourself in these terms. This consistent practice will, over time, rewire the neural pathways that lead to panic or euphoria, replacing them with pathways of detached curiosity. You are training your brain to see opportunity where others see only danger or temptation. The second step is to build your value anchor. The Mr. Market framework is useless if you don't have an independent assessment of value to anchor your decisions. Without it, you are just as susceptible to his mood swings as anyone else. Your primary work, therefore, is not to predict the market's direction, but to understand the businesses you might potentially own. This means doing the hard, unglamorous work of reading annual reports, studying financial statements, and analyzing a company's competitive position. You must, for any potential investment, be able to answer the question, if the stock market were to close for 5 years, would I be happy owning this business? This forces you to think like a business owner, not a stock trader. You need to arrive at a conservative estimate of a business's intrinsic value, what it is truly worth based on the cash it will generate over its lifetime. This value becomes your anchor of reality in the stormy seas of Mr. Market's emotions. When the price plunges below your calculated value, you know it's a potential opportunity. When it soars far above it, you know it's a potential risk. Without this anchor, you are lost. Your value calculation doesn't have to be precise to the penny, but it has to be rational and well-founded. It is the only thing that allows you to confidently act when Mr. Market is screaming that you are wrong. It is the foundation of the courage to be contrarian. The third step is to develop an emotional inoculation protocol. You must anticipate and prepare for the intense psychological pressures you will face. A protocol is a predefined set of rules and procedures to be followed in a high-stress situation, designed to bypass emotional decision-making. Your protocol should include several components. First, a checklist for investment decisions. Before buying or selling, you must mechanically go through a checklist of criteria. Does this fall within my circle of competence? Have I calculated a conservative intrinsic value? Is there a significant margin of safety between the price and my calculated value? What are the primary risks? This forces a slow, logical process over a fast, emotional reaction. Second, conduct a, quote, pre-mortem. Before making an investment, imagine that it has gone disastrously wrong a year from now. Write down all the possible reasons why it failed. This helps to identify risks you may have overlooked in your initial enthusiasm and counteracts overconfidence bias. Third, establish rules for engagement with financial media. During times of extreme market volatility, your protocol might be to completely abstain from watching financial news or checking your portfolio for a set period. This starves the emotional part of your brain of the very fuel it thrives on. You are creating a controlled environment to protect your rational mind. Finally, practice negative visualization. Regularly visualize a scenario where your portfolio drops by 30% or 50%. Feel the fear and panic that this would induce. Then, walk yourself through your protocol. How would you react? What would you do? By rehearsing these scenarios mentally, you inoculate yourself against the shock and awe of a real market crash, making it more likely that you will stick to your rational plan when it matters most. The fourth and final step is to cultivate the temperament of a predator. This is a shift in mindset. For most people, patience is a passive, frustrating state of waiting. For the investor using the Mr. Market framework, patience is an active, strategic stance. Think of a crocodile in a river. It can remain perfectly still for days, even weeks, conserving energy. It is not idle. It is watching, waiting, with absolute focus, for the precise moment when a wildebeest comes to drink from the water's edge. At that moment, it explodes into decisive, violent action. This is the temperament you must cultivate. The long periods of market calm or euphoria are your time to be still. You are not bored. You are not missing out. You are conserving your capital, your predatory energy. You are studying the environment, identifying the strongest businesses, the healthiest wildebeest, and waiting for Mr. Market's inevitable emotional breakdown to provide the opportunity. When the panic sets in, when the wildebeest is vulnerable at the water's edge, you do not hesitate. You act with speed, confidence, and decisive force because you have done the preparation and you recognize the opportunity for what it is. This reframes the entire experience of investing. It is no longer about the frantic, day-to-day chase for small gains. It becomes a long-term strategic game of psychological warfare, where your primary adversary is not the market, but the emotional reactive tendencies within yourself and the collective. By personifying the market, anchoring yourself to value, creating an emotional protocol, and cultivating a predatory temperament, you are not just adopting a new strategy. You are installing a new cognitive operating system. An operating system designed to filter out the noise, to resist emotional contagion, and to systematically exploit the most predictable and enduring feature of financial markets, human irrationality. This is the profound lesson of Mr. Market. It teaches us that the path to extraordinary wealth is not paved with complex algorithms or secret information. It is paved with discipline, patience, and a deep understanding of human psychology. It is the understanding that your greatest asset as an investor is not your IQ but your emotional fortitude. By learning to manage your relationship with your irrational partner, Mr. Market, you transform the market from a source of anxiety and risk into a reliable and perpetual engine of opportunity. You learn to see the panic of others not as a reason to flee, but as a formal invitation to buy. You learn to see the euphoria of others not as a reason to celebrate, but as a signal to exercise extreme caution. This is the cognitive shift that separates the amateur from the master, the ambitious from the ultra-wealthy. You stop trying to predict the rain, and instead you focus on building the ark. Then, you simply wait for the flood, knowing that it is not a catastrophe, but the very event that will lift you above all others. The mastery of this single mental model is the foundation. It teaches you the critical importance of temperament and provides the psychological framework for knowing when to act, to strike when fear is at its peak. But this is only one half of the equation, the trigger for action. The other, and arguably more critical half, addresses the question of what to buy when that moment of opportunity arrives. Because when fear grips the market, everything goes on sale. The good, the bad, and the businesses that are destined for failure. Buying a mediocre business, even at a deeply discounted price, is a common trap for the amateur investor. It's a value trap. The true secret of the ultra-wealthy, the second layer of this cognitive operating system, is to use the opportunity created by Mr. Market's panic to purchase not just cheap businesses, but Simon Invincible businesses. Companies that possess structural advantages so powerful, so durable, that they are virtually immune to the forces of competition. They are economic fortresses. Warren Buffett has a specific name for these structural advantages. He calls them an economic moat. Understanding how to identify these moats is the essential next step in building a complete wealth creation framework. It is the filter you apply to your shopping list, ensuring that when you deploy your capital into the heart of a panic, you are buying assets of untouchable quality. If you want to deconstruct the exact cognitive architecture Buffett uses to identify these fortress-like businesses, to learn the 4 distinct sources of durable competitive advantage that create these moats, and to rewire your own brain to see the invisible structures of power that separate the true winners from the temporary players in the capitalist game, then you must watch the video that is appearing on your screen right now. It is the logical and essential next part of this education. Click the video on the screen, and we will begin the deconstruction of the economic moat.